from the start itself, we need to specify that the current legislation which the ministry has put out, there is very limited information on the free zones, and it is specified that another cabinet decision will be published detailing much more specifics about the free zone taxation requirements. So firstly, in the current legislation, it has introduced certain terms. Firstly, the first one being the qualifying free zone. And so as per the law, in order to be treated as a qualifying free zone, the free zone entity must maintain adequate substance in UAE. Second condition is that it needs to derive qualifying income, which is another one of the term that has been introduced in the legislation. And the third requirement is that they need to comply with the transfer pricing rules and maintain the relevant transfer pricing documentation. So for free zone companies who have related companies and transactions with the related companies, it needs to be ensured that they need to comply with the transfer pricing rules as in relation to arm's length pricing, etc. And adequate documentations will have to be maintained and provided to the tax authority in the event of any assessment. And the transfer pricing, as we mentioned earlier in the session, we'll be conducting a separate session on transfer pricing and the documentation, etc., which is scheduled for Jan 23rd, Monday at 3 p.m. UAE time. So if you are a free zone company or even a mainland company who have related parties and transactions with the related parties, make sure you attend that webinar because this is a very crucial topic. And the last condition is that you have not elected to be subject to a corporate tax in full. See, the legislation, they are giving an option to the free zone company. So either the free zone company can opt to be taxed at 0% on their qualifying income, or they can say that we don't want that sort of an exemption and will comply with the full corporate tax rate of 9% on their entire income. So it gives an option for the free zone companies to elect. Now, these conditions which they have mentioned, it is mandatory to follow, especially the one regarding adequate substance. I mean, for companies who know about the economic substance regulation that was introduced in 2019 and who are already filing the reports, you need to make sure that your company has adequate substance or resources in UAE for the level of income you are earning. So that substance requirement can be in terms of assets and resources being utilized from UAE, adequate employees in UAE, and also the fact that the company is being directed and managed from UAE. So if you are a free zone company who elects to avail a 0% corporate tax, you need to make sure that these conditions are satisfied. That is especially with regard to economic substance. Now, a qualifying free zone person will be taxed at 0% corporate tax on their qualifying income. And for any non-qualifying income, the tax rate will be 9%. Now, this is the second term that I mentioned that the legislation has introduced, that is the qualifying income. Now, the law has not, the current legislation has not explained what this qualifying income is. Now, many of you may have gone through the public consultation document which was released last year. So in that they had proposed corporate taxability for a free zone company, where they say that if a free zone company earns income from mainland UAE, then they will be subject to 9% corporate tax. And and if they earn only income from outside UAE, then it could avail 0% corporate tax. So the qualifying what is this qualifying income? That is not yet announced. So we need to wait for the cabinet decision. I know it's disappointing for many of you, but unfortunately the ministry has decided that it needs to revisit and make sure it gives a proper let's say exception to the free zone so that they are not in a disadvantage. So we believe that is why they are not yet released the public the cabinet decision relating to the qualifying income. So it is so for any qualifying income which is listed in the upcoming cabinet decision, you will be eligible for a 0% corporate tax. And for any income that you earn which is not part of that qualifying income list, it will have to be taxed at a 9% corporate tax rate. Now, the important another question that pops up along with this is that how do you maintain the accounts relating to denoting what is how much is your qualifying income, how much is your non-qualifying income, and regarding the apportionment of expenses, etc. So these are a lot of questions which is still unanswered, unfortunately, in the current legislation. But the ministry will be releasing a cabinet decision which will detail the specifics as to what a qualifying income is, what records needs to be maintained to evidence the net taxable income from a qualifying income and the non-qualifying income. Now, The thing is, another point is that the qualifying person can elect to apply for a 0% eligibility if they have any qualifying income, or they can opt for to be taxed at 9% on their entire taxable income. But the law says that you can make an election before the start of a tax period, but it is silent on whether you can revoke that election. So if you make an election saying that for your financial year 2025 you will avail this 0% benefit on qualifying income, it does not say once you make an election can you go back to having 9% on your entire taxable income. The law is silent on that, so we again need to wait for that cabinet decision, a very important cabinet decision that everyone is waiting for. Now, regarding some of the other requirements which is specified in the current legislation, all free zone entities will have to get registered and file a corporate tax return, whether they elect to have a 0% or 9%, that is whether you fall within the qualifying free zone category. So the administrative compliance requirements will be there regardless of whether you are taxed at 0% or 9%. And as you may know that in VAT you have a segregation in terms of free zone where you have a designated zone and a non-designated zone. But the current legislation for corporate tax, it doesn't make any segregation of sort. So currently, as of now, for corporate tax purposes, all free zone companies are considered as the same unless anything opposed to it is mentioned in the cabinet decision. So maybe it's tied up with what is the qualifying income, especially for trading goods, similar to how you have exception in VAT for trading companies inside a designated zone when they sell to mainland or outside. It is expected that the qualifying income could cover those sort of transactions, and the 0% eligibility could be availed for such types of income generated. And the qualifying free zone entities that are part of a large multinational group, they could have a higher tax rate. Now, to be more clear, the UAE had introduced the CBCR regulations whereby they had defined what a large multinational group is. It represents a multinational group whose annual turnover exceeds around $900 million. So if you are part of such a multinational group, it is possible that you could be taxed at a higher rate of say 15% based on the Pillar 2 rules that are currently in contemplation of being introduced. So this is only applicable for free zone companies who are part of a multinational group. So if your multinational group does not have that turnover threshold, then you would be outside of this possible higher rate. And again, the ministry has not defined what this higher rate would be. Again, that will be addressed in the upcoming ministerial decision. So unfortunately, these are the points that they have given in the legislation regarding free zones. So it is still, many of the things are still open to interpretations, and we need to still await an official confirmation from the ministry regarding what exactly this qualifying income is, what is the nature of business or nature of income that falls under this. So that you will know exactly whether which income or which taxable income of your company will be taxed at 0% and which will be taxed at 9%. Now let's look at related parties. So related parties, the legislation has categorized 6 types of related parties. Now, in terms of natural persons, 2 or more natural persons who are related within the 4th degree of kinship or affiliation will be regarded as related parties. So, if you say 4th degree, that means it can extend upwards up to your great grandfather or up to your great grandson of a particular natural person. So, for any natural person, those category of persons within that degree of kinship will be regarded as related parties. Now, in terms of a natural person and a juridical person, if a natural person or one or more of its related parties alone or together, directly or indirectly hold 50% or greater ownership in a juridical person, or a natural person alone with its related party directly or indirectly controls the juridical person. So, if you look at an individual and a company, whether they are considered as related parties will be determined based on this criteria. So if that particular individual or its related party indirectly or directly holds 50% or more ownership interest in that particular juridical person, then that individual and that juridical person will be considered as related parties. Or the second criteria is that if the natural person or its related parties have a control over the juridical person. Now, what this control is, to what extent the related party relationship will exist. These will be discussed in detail in the upcoming transfer pricing regulations. So make sure you attend that. We are just going through the basics which are detailed in the current legislation. So with regard to two juridical persons, one juridical person alone or together with its related parties directly or indirectly owns 50% or greater ownership interest in the other juridical person, or one person alone together with related party directly or indirectly controls the other juridical person, or one person alone or together with its related parties directly or indirectly owns 50% or controls such or two or more juridical persons. So this is in relation to two juridical persons. So if you have two companies who have ownership, if one of the companies have ownership in the other company over this 50% threshold, or if it has control over the other juridical person, then those two juridical persons will be considered as related parties for corporate tax purposes. Now, the fourth category is that a person and his permanent establishment or foreign permanent establishment. So, if a person has a overseas branch, or if a non-resident person has a UAE branch, then those two will be considered as related parties. And the fifth category is two or more persons that are partners in a same unincorporated partnership. Now, unincorporated partnership, that could refer to joint ownership of properties, etc. So, if you have such unincorporated partnerships in force, then the two persons who are part of that partnership will be considered as related parties. And the last category is a person who is a trustee, founder, settler, or beneficiary of a trust or a foundation and its related parties. So the next category that is given in the law is regarding connected persons. Now, the connected persons are different from the related parties. So the following are considered as connected persons as far as a business is concerned: the owner of the business, the director or officer of the business, or a related party of either of the above. So a shareholder of a business is by default considered as a connected person of that particular business. Also, the director or any officer of that business is considered as connected, and any related party of the such an owner or a director or an officer will also be regarded as a connected person. Now, the implication for these connected person is that you need to comply with the arm's length pricing and the market value assessment when you make any payments against services to such persons. So, if a shareholder earns salary from its own from his or her own company, then that would be subject to arm's length pricing. Now, what is the benchmark for this particular? So, if a shareholder earns a salary, what is the benchmark that should be compared for this particular arm's length assessment? That is not yet determined by the law. So, again, more details regarding that needs to come out. Also, an owner of the taxable person is any national person who directly or indirectly owns a ownership interest in the taxable person. So that is the basic definition of who is the owner of a business. And where a taxable person is part of a unincorporated partnership, a connected person is any other partner in that same unincorporated partnership, and any person that is related of that partner. So any partners in an unincorporated partnership will also be regarded as connected persons. Now, arm's length principle, ALP or transfer pricing. Now, this is very important when it comes to your transactions with related parties or connected persons. As mentioned, we'll be conducting a detailed session on this on Jan 23rd at 3 p.m. So, if you have any related party or connected persons, and if your company or business has transactions with such related parties, you need to make sure that the transfer pricing and arm's length rule is complied with. Now, the transfer pricing rule seeks to ensure that the transactions between related parties are carried out at arm's length terms, which means that you cannot say reduce the amount you, if you are selling goods to any related party, or if you are providing any services to your related party, you cannot reduce that unduly to gain benefit or of a corporate tax advantage. So if you're providing any services or making any supply to your related party, you need to make sure that it complies with the general market rate. So if the same service or same supply of goods is made to an independent or third person, it should come in the price you charge to your related party should commensurate with what you charge to a third party. So you cannot manipulate any pricing in terms of related party transactions. So that will be taken up under that will be covered by these transfer pricing regulations, and you also need to make sure that adequate documentation is made to is available to evidence that you have carried out at a normal market price. Now, transfer pricing rules applies to UAE businesses that have transactions or related parties, and there is no distinction between a free zone company or a mainland company or a company in a foreign jurisdiction. So, if you are a business established in UAE mainland or a free zone, and if you have a connected person or related party within UAE or outside UAE, the transfer pricing regulations will apply for the intercompany transactions. Now, this particular transfer pricing, it applies to all transactions with your related party and connected persons, including loans. So, if you provide any loans to your related party, or if you avail any loans to your related party, it is vital to make sure that the interest that is applied on the loan and the duration, etc., commensurate with what is there in the industry standards. So, you cannot say take a loan from a related party at a very high rate so that you can deduct it from your taxable income. That will not be allowed. So any transactions with the related parties, including loans, intercompany loans, will be strictly monitored, and you need to maintain the adequate transfer pricing documents to evidence to the FTA that this is being done in a normal commercial manner without trying to take any advantage in terms of corporate tax exposure. Now, the next category is tax loss. So, tax loss is where your operating expenditure exceeds your net income, then that will result in a tax loss. So, as per the legislation that has been put out, a company which incurs a tax loss in their tax period is eligible to carry forward this tax loss into their future years. And one thing that you need to understand is that there is no definite period up to which this loss can be carried forward. So, if you incur a loss, if your first tax year is in 2024, Jan to December 2024, where you incur a loss, you are eligible to carry forward this tax loss to an indefinite period in the future, which can be then offset against any future income. But they have certain limitation on the maximum amount of loss that can be deducted from your operating income in a particular year. So that maximum ceiling limit is 75% of the taxable income in each of those future tax periods. So if you look at the example, a taxpayer has a taxable income of 500,000 and a carry forward loss of 600,000. Now this carry forward loss of 600,000 can be offset against that future income of 500,000 subject to a 75% limit. So it can offset up to a 75% of 500,000, which is 375,000. So if you incur a tax loss of 600,000 in a particular year, and in the subsequent year you have a taxable income of 500,000, you can offset up to 375,000 of that carry forward loss in that future year, and any excess loss remaining after that offset can be carried forward again to your future periods. So in this particular example, the set of loss will be 375,000, and the balance 225,000 of your accumulated tax loss can be carried forward, which can be offset in the future year's income. So, as mentioned, the tax losses can be carried forward without limitation for a company, but there are certain conditions attached to it. So, if a company is eligible to carry forward its tax loss, provided there is no considerable changes in its ownership. So, what the law says is that a tax loss can be carried forward without limitation, provided the same person or persons continue to own at least 50% of the entity with the losses. Where there is a greater than 50% change in ownership, the tax losses may still be carried forward, provided there is no major change in the nature of conduct or entity's business. So in the sense, if you have a tax loss in the year 2024, and in 2025, there you undergo a shareholding change in the company. So if the shareholding change is up to a 50%, if the existing shareholder as of 2024 holds their interest in 2025, you will still be eligible to carry forward the tax loss. However, if there is a major overhaul in your shareholding structure, in the sense that the shareholder who was there in 2024 is no longer a shareholder in 2025, then there are additional conditions to be satisfied to carry forward that previous year loss. So you cannot take benefit from a year where the shareholding was different. And what they have said is that if there is a major change in shareholding over 50%, then there should not be any change in any nature or conduct of the entity's business. So you cannot drastically overhaul the entity operations or the nature of business along with a major shareholding change. So if anything, if any of that instance happens, then you might be at a risk of not being able to utilize the previous year tax loss. Now, there is also another provision where you can offset the tax loss of one company against another company which is owned by you. So this is different from a tax group that needs to be understood. A tax group have very high threshold limits in terms of ownership. So this is for companies who do not meet the tax grouping criteria. The law has provided certain benefits in terms of adjusting intercompany tax losses. So the conditions for doing that is that both companies are UAE residents. So the both companies in question should be resident in UAE. Either owns 75% or more of the other, or a third party owns 75% more of both the entities, and the ownership existed at the start and end of the tax period in which the loss was incurred. So either the company should have a shareholding in the other of over 75%, or at least there should be a common shareholder holding 75% or more in both the companies. So in such cases, you will be eligible to offset the profit or loss of one company with the taxable income of another company, even though you might not have registered as a tax group. Now, the other condition related to this is that neither company is an exempt person, so you cannot offset the loss of a taxable person with an exempt person's income, and neither company is a qualifying free zone business. So if a particular shareholder owns 75% or more in a mainland business, and he or she owns 75% or more business in a qualifying free zone, which is availing a 0% corporate tax rate, then you cannot offset the losses between these two companies. So it is important that the companies in question are subject to 9% corporate tax itself. And further, the financial statements of both the companies should be prepared using the same accounting standards and also should have the same financial year. So you cannot offset the losses of companies which are following separate financial years. And further, no tax loss transfers will be allowed from companies that are exempt or benefit from zero corporate. This is a reiteration of what I had said before. So if you have a free zone company which is availing 0% corporate tax, then tax loss cannot be offset with a 9% fully taxable entity, even though you may meet the 75% ownership criteria. The next is regarding withholding tax. So in UAE, the legislation has announced that there will be withholding tax. However, the rate of withholding tax for the moment is 0%, but this can be changed via a cabinet decision at a later stage. And this withholding tax primarily will apply to state source income of non-resident business persons. And further, foreign tax paid or income that is also subject to UAE corporate tax can be deducted as a foreign tax credit from the UAE payable. So if your business has paid any tax on your income in any foreign country, this can be claimed as a relief and be deducted from your UAE corporate tax that is payable. Now, the maximum foreign tax credit is lower of the foreign tax paid and the UAE corporate tax payable on the relevant income. So it will be lower of the tax amount you have paid in another jurisdiction versus the corporate tax payable. So whichever is lower, you will be eligible to deduct. Further, you cannot. So further, if there is any unutilized foreign tax credit, it cannot be carried forward to a future period. Now, let's look at tax groups. Now, this is different from that earlier tax loss adjustment between companies, because the law allows you to form tax groups similar to how it is in the VAT regulation. So if UAE companies who has common ownership of 95% or more, they will be eligible to apply for a tax grouping condition. So UAE companies can apply to form a tax group and be treated as a single taxable person if the UAE parent company directly or indirectly holds at least 95% of the share capital and voting rights each of the companies. So in the example, the company A owns 100% of company C, and company C owns 80% of company B, and company A also owns 20% in company B. So indirectly, the company A owns 100% ownership in company B as well. So all these companies are eligible to form a tax group under the corporate tax regime. Now, to form a tax group, neither the parent company nor any of its subsidiaries can be an exempt person or a free zone entity benefiting from a corporate tax rate. Again, they have put a restriction on any free zone companies who will be eligible for a 0% corporate tax rate. So, so such a free zone company and its mainland entity will not be allowed to form a tax group. And also, all companies in the task group must follow a same financial year and should prepare their financial statements using the similar accounting standards. Again, the task grouping criteria similar to VAT is purely at the discretion of the FTA. So you are eligible to apply to form a tax group. However, it is up to the FTA to assess whether that application needs to be approved or not. Now, subsidiaries of foreign parent company. So if you have multiple subsidiaries in UAE and which belongs to a foreign parent entity, such subsidiaries are eligible to form a tax group, provided there is an intermediary company in UAE who has shareholding in these subsidiaries. So it is not that the subsidiaries of foreign companies will not be eligible to form a tax group, provided they're eligible only if there is an intermediary UAE entity that will act as a parent company for such subsidiaries. Now, can you have a foreign entity in your tax group? No, unless the foreign entity is managed and controlled in UAE and considered as a UAE resident entity for UACT purposes. Now, this is linked to the permanent establishment that was explained earlier. So, if any foreign entity which is deemed as a resident based on the permanent establishment rules, then such foreign entities will be eligible to form a tax group, but any other foreign entities will not be eligible to form a tax group with any UAE resident companies. Now, the threshold regarding tax group, it needs to be noted that even if you form a tax group, there is only a single threshold of AED 375,000. So, if you are a group who has, let's say, like five companies, and if you are individually filing a corporate tax return, each company will have a threshold limit of 375,000, above which you will be taxed at 9%. But if you decide to group all these 5 companies together, then the 375,000 limit for the 0% corporate tax will apply to the entire group as a whole. So you will not be able to use this minimum threshold limit for each company which is part of that group. So you may need to assess your exposure before deciding to form a tax group. Now, similar to VAT, the responsibility of filing a UAE corporate tax return and the responsibility to pay the UAE corporate tax will remain with the parent company, which is in effect the representative company of the group. So the representative company will be filing a single corporate tax return on behalf of the entire group, and it will be responsible for settling the corporate tax due within the deadline as per the law. Now, for the period they are group members, the parent company and each subsidiary will be jointly and severally liable for the corporate tax obligation. And by way of application to FTA, you can also request to limit the liability and the obligation to certain members of the group and not have all the members involved. Is it mandatory to prepare consolidated financial statements? Yes, the task group will have to consolidate the financial results of all the members in the group to derive the taxable income, and they need to make sure that the intercompany transactions are offset or eliminated while preparing the consolidated financial statements. And this consolidated financial report will be used as a basis for calculating the taxable income of the group as a whole. Now let's look at the financial records. Now the taxpayers are expected to prepare and maintain financial statements for the purpose of calculating taxable income, and they are also required to maintain adequate documents and records to evidence their income as well as their expenses. So record keeping is extremely important now that the corporate tax regime has come in. And every person is, and even an exempt person is required to maintain records and evidences to support that they are indeed eligible for an exemption. So, if you fall within the exempt category, you cannot decide that okay, the record keeping and the documentary requirements are not applicable for me. Even for exempt companies, they need to maintain adequate records to evidence that they are indeed exempt. And how long the records need to be kept? The records have to be kept for at least 7 years following the following the end of the relevant tax period. So the record keeping norms are tightening up in UAE. So if there are any companies who are still lacking in any of the record keeping requirements, they need to make sure that they're up to speed before their first corporate tax period, or at least even with the even in the year prior to the first corporate tax period. Now, do you need to audit the financials? That they have not mandated in the legislation, but they have specified that certain categories of taxable person listed in a cabinet decision will be required to prepare and maintain audited or certified financial statements. It is expected that this category could be the free zone taxable persons, because this was proposed in that initial public consultation document. They have not yet mandated for all companies, but they will be announcing which category of taxable persons should keep audited financial statements. Maintenance of accounts is compulsory. Auditing, that we need to wait for the cabinet decision to come out to see which category it applies to. Now, submission of financial statements of to the Federal Tax Authority. Now, the FTA can request, as in the case of VAT, if an audit happens, the FTA can request for the financial statement to be submitted along with the corporate tax return, which is upon request. So straight away at the time of return submission, you may not need to submit the financials, but FTA can always ask for that to be submitted. Now, another important point is regarding the currency. Now, the law states that all amounts must be quantified in AED currency for the purpose of taxable income calculation, and any translation from a foreign currency to AED currency will have to be done at the applicable exchange rate set by central bank in UAE. This is similar to how we have in VAT. Now, the point here to note is that the legislation has not specified that each transaction in a financial period have to be translated into AED currency. It has given a broad terminology saying that all amounts must be translated at the exchange rate specified by the central bank. Now, however, if you look at the FAQ published by the Ministry of Finance, in there they have clearly stated that every transaction will have to be translated into AED currency at the rate prescribed by the central bank. So there is a bit of a conundrum in the sense, does the law mandate you to translate every transaction, or does it permit year-end translation of the books of accounts? So since they have specified that every transaction needs to be translated individually in the FAQ as per the ministry website, we would recommend you to have the books in AED itself. In case in the subsequent cabinet decision they specify that every transaction needs to be translated at that applicable rate of the transaction, then that will cause a hassle for you. So if you are maintaining books in any other currency, it's advisable to have the books books kept in AED currency itself going forward. It'll save you a lot of administrative trouble. Now, what are the general administration requirements under the corporate tax regime? It is a self-assessment. So you need to prepare the corporate tax return and submit to the FTA, and it will then be subject to an assessment at a later stage if the FTA deems necessary. Now, all taxpayers, as prescribed by the minister, will be required to register for corporate tax and obtain a corporate tax registration number. Now, the corporate tax registration has not yet started. What the ministry has mentioned during their live seminar is that it will be on invitation basis and it will be stage-wise. The companies will have to register for corporate tax. So some of the companies may receive an invitation to get registered early, and others will have to get registered once the registration gets open to the public. Now, the taxpayers are required to register before they file their first corporate tax return. So there is no time limit as of now. But what the ministry has said is that before your first corporate tax return is due, you will have to register for corporate tax. There is no registration threshold for corporate tax that has been prescribed in the law. So even though you have a threshold for the taxable income, there is no threshold prescribed for the registration under corporate tax. So in effect, all businesses in UAE will end up having to get registered for corporate tax. Now, the taxpayers will be able to electronically register through the website of the Federal Tax Authority. Further guidance is awaited. If you see the Federal Tax Authority website, currently there is no option to get registered for corporate tax. So that will be coming out in the near future. And another question we face is that we are already registered for VAT and we already have a TRN number. So should we again register for corporate tax? The answer is yes, you will be required to register for corporate tax separately, because Not all companies may be registered for VAT. Like for companies in designated zone who might mainly have out of scope supplies, they may not be registered for VAT in UAE. So what ministry has said is that irrespective of whether you have a VAT registration or not, you will need to register separately for the corporate tax. Now the next one is that there is only one corporate tax return for a particular tax period, so there is no interim return or anything anything similar to that applicable. So once your tax period ends, you have 9 months within which you need to prepare and submit your corporate tax return. And for this 9-month criteria, 9-month deadline applies to both submission of your corporate tax return as well as payment of corporate tax. Now, all taxable persons are expected to file a corporate tax return irrespective of their level of income. So the law has not excluded any companies who are below the 375,000 taxable income threshold. So every company is expected to file a corporate tax return whether their taxable income is below 375,000 or not. What they have said is that for small companies, they might provide a simplified corporate tax return submission procedure. Now, all taxable persons are also required to file a corporate tax return whether they have made a profit or not. This is very crucial if you need to carry forward your tax losses. So, in order to be eligible for carry forward of tax losses, it is expected that you will need to comply with the return submission deadlines, and you will indeed have to file a corporate tax return. If the companies meet the requirements of a tax group, then there is only one return for the entire group. So all the individual members in the tax group doesn't have to file individual tax returns. So then, similar to how you have in VAT, there will be one corporate tax return for the entire group, and the representative member will be responsible for submission. Now, next is that your corporate tax return submission will be electronically filed. There's no hard copy or anything like that. And corporate tax will have to be paid within the 9-month deadline following the financial year. So if your financial year is ending on December 2024, you have until September 2025 to submit the corporate tax return and make payment of corporate tax. And there is no requirement currently for payment of any advance tax as how you have in other jurisdictions. So the payment and the return submission will be one time. So there is no prior period payment or interim payment to be made in between. And regarding the payment method, it's yet to be decided as to what the payment method would be. And obviously, there will be penalties for non-compliances with non-compliance under the corporate tax regime. So you can expect penalties for delay in submission, delay in payment, or failure to keep books of accounts and records, etc. But these penalties are yet to be published. And that will be the end of our presentation. So I think we can move on to some of the Q&A questions that people have posted over here.
Yeah, in fact, we clarified most of the questions posted here. I think many of the questions were related to free zone companies. As we already explained, the law is